Right. So over to you, Femke.
Thank you. All right, thank you so much for the introductions. Thank you everybody for being here. We have more than 200 attendees at the moment, which is great. It's a great honor for me to be with you here today and to share our story, both of the report that we wrote ACCA, and also I'd like to share some of the findings of a study that we're currently conducting on Bangladesh as a case study. My name is Femke Groothuis. As explained, I lead a think tank focused on fiscal innovation for the SDGs and the circular economy. And in my previous life, I was an investment manager at a green investment venture capital company. So as you will notice during my presentation, we take very much the perspective of the business community and understanding the dynamics in business and the role taxes play in business decisions. So the idea that we work on is quite simple. These principles are very simple. It's to tax natural resource use and pollution and lower the tax burden on labor while increasing social spending or other types of spending. And to do that wisely, of course. This is a subject that we've been doing a lot of research on. And over the years, I've learned, and especially coming from a business background, it's pretty clear that taxes on labor actually incentivize businesses to minimize employment or to minimize formal employment, adding as formal employment adds to the cost for employers. I'm not saying this is a good thing, but it's just the drivers that we have in our business decision making. Entrepreneurs seek for ways to reduce their payroll costs, and they do that by lots and lots of different ways. For example, by shifting to automation rather than handmade products, by shifting to mass production rather than custom-made products, by lowering service levels, for example, shifting production to lower income countries. So there's lots of ways how businesses actually try and minimize the role of human labor in their business models. And when we talk about labor taxes, we mean both personal income taxes, social contributions, and payroll taxes. So we look at the broad spectrum of labor taxes. Now, on the other hand, when there are low or non-existent natural resource taxes, we use resources unrestrained. And when I say resources, natural resources, I mean the whole spectrum of natural resources, ranging from water to clean air, but also the use of metals and minerals, waste streams that we produce, etc. So all the interactions that we can have with the natural world. In OECD countries where we have a lot of data, $14.8 trillion in taxes are collected in 2016. And 51% of those tax revenues were based on labor taxes. So again, personal income tax, social contributions, and payroll taxes. Now, on the other hand, if we look at green taxes, they only provided 5% of government revenues in 2016 across OECD countries. Now, the database of the OECD contains a lot more countries than just the OECD members. Across the board in that database, labor taxes have increased in 73% of the countries in the OECD database over the 2000 to 2016 period as a percentage of GDP. This means that of the 73 countries which are in the database and have their data there, 53 actually increase their share of labor taxes as a share of GDP over the 2000 to 2016 period. So they're on the rise generally. Environmental taxes or green taxes have actually declined in a majority of the countries in the OECD database. 52 countries of the 79 that we could find recent data for have actually decreased their share of green taxes as a share of GDP. but we're not just not taxing natural resource use, we're actually subsidizing pollution. Global fossil fuel subsidies in 2017, according to the IMF, were $300 billion just in that year. And this is according to the, let's say, general definition of subsidies. So, but if we look at a broader perspective, the IMF also analyzed how much the external costs of these subsidies were. So by how much, what kind of damage are these subsidies causing? And when you include the externalities of the use of fossil fuels, the subsidies between brackets are even $5.2 trillion in 2017. There's a lot of debate on this concept, but it's very clear that if you look at the external cost of combusting fossil fuels, the cost to society are very large. Now, what we can read in these data is that financial incentives are currently aligned with the linear economy, the take, make, waste economy, in which resources are taken from the earth or taken from the air. We turn them into products, and after a very short lifetime, that we turn them into waste. In that process, we tend to minimize human input in many parts of the world. And at the same time, there's a lot of costs involved with these processes in terms of health impacts, of pollution, damaging resources, damaging forests, etc. And these costs are not borne by the polluter. So, for example, if we look at the economic cost at the left-hand corner of ocean-based plastics pollution, that's $13 billion per year. And mismanaged waste causes 400,000 to 1 million deaths each year in developing countries. Air pollution costs $5 trillion per year. And 80% of global greenhouse gas emissions are free of charge. That means that the polluter doesn't pay these costs. These costs are turned over to society or to individuals who have to pay with their life or with their health. Basically, we're draining natural capital in the world. And at the same time, human capital is growing. We're growing to 9.8 billion people by 2050. And there's a massive need for decent jobs. There's 83 million people more every year on this planet. And that means that all these people have qualities and capacities that and a need for decent living. So the SDGs came on, and they are basically humanity's to-do list for the next decades. And the interesting thing is that they marry social issues as well and environmental issues. So social and environmental issues are no longer disconnected. We understand that they are interconnected. But we do know now that the linear economy that I just explained, with all the costs and all the pollution that comes with it, is unfit for the SDG era. We're not going to achieve the SDGs if we continue on the path of the linear economy. So the SDGs are also a massive financial challenge. According to the UN, they're going to cost $5 to $6 trillion per year to achieve. And developing countries alone face a financing gap of $2.5 trillion per year. As official development aid is only $153 billion per year and on a declining trend, there is a massive financing gap. So the challenges: could business models be rethought, as UNEP Finance Initiative says, in ways that would increase SDG serving financial flows? We have to get public and private interests aligned so that making a profit also means creating value on different areas. And this is where the circular economy as a concept has come up. The circular economy is a regenerative and carbon neutral system in which resources are brought in closed loops and businesses can add value over and over again by applying smarter business models. And we're only beginning to explore this concept properly. But a number of governments have already created circular roadmaps, especially in Europe, but also China, for example. And some are very rough or unclear. Some are very specific. The Netherlands, for example, has a goal of reducing materials use, resource use by 50% by 2030. Well, in fact, nobody knows how to get there, but it's now an official government goal. Governments also around the world are going carbon neutral. There's more understanding of the vision, and a number of countries are now stepping up to the plate and setting very ambitious targets. And the list is changing every month. So I'm sure we can probably add some more already now. So this is a big development. And then businesses are also going circular. In our Tax as a Force for Good report, we describe a number of business model innovations, and we give a selection of examples by industry. You can have a look online if you want. I'm not going to go through all of them today, but they range, from food industry to vehicles and tires and consumer goods, as well as in technology, in financial services, etc. There's a lot going on. There's a Dutch bank, ABN AMRO, for example, that has committed financing €1 billion worth of circular assets by 2020. And basically in every sector, these types of really big goals and new business models are coming up. And the circular economy means it should be good for business. It just changes the business. It means shifting from mining primary resources to urban mining, so mining secondary resources. It means moving from fossil fuels to renewables. It means moving from sale to re-commerce and rental services. And it means moving from incineration and landfilling to reuse of materials. For example, Adidas making 1 million shoes of discarded fishing nets. According to Accenture, the circular economy should be a $4.5 trillion global business opportunity by 2030. And companies are taking these strong commitments. IKEA, for example, who have just entered the market in India, I understand, have a goal to become circular by 2030. And Google has aimed for zero waste and wants to play a role in circular economy data. Artificial intelligence will be hugely important in managing resource data. Philips has decided to be circular by 2025 for their large medical equipments. And there's an initiative called the RE100, in which 152 companies have committed to 100% renewable power. And then, for example, in the fashion industry, there is a circular fashion system commitment signed by 94 companies that hold 12.5% of the global fashion market. The only thing is with the circular economy is that the business models that are needed will be more labor intensive and knowledge intensive compared to the linear business models. Because a circular economy really requires a redesign of products and supply chains. It requires a lot of R&D to develop new materials and new technology, new processes. Moving to lease models where the owner of a product, the manufacturer, actually gets the product back after a certain life cycle is more labor intensive. It requires tracking, more legal services as well, and a different financing model. Providing repair services or maintenance or refurbishment, remanufacturing, it all requires more human input. Take back systems, organizing for all those products to come back, spare parts harvesting, the urban mining, and the training that comes with that. People need to be trained to work towards these new products and supply chains. So that could be a downside, but it's, I think, an upside because it means that we can create an economic system that is more inclusive as well. Again, this is what the SDGs envision, in my opinion. A type of economic growth that is based on human capital instead of the extraction of natural resources. So as I said, we do need tax reform to align financial incentives with those goals of the SDGs. And we think an important part of that puzzle would be to tax natural resource use and pollution rather than labor, and to increase social spending and spending on other public goods. Now, over the years, I found out that there's been a lot of support for this type of tax reform. The European Commission has been calling member states to change their tax systems for more than 20 years. The European Parliament, the OECD, the IMF, the ILO, and even the World Business Council for Sustainable Development has written about this concept. And the concept has also been put in practice in a number of countries. In Sweden, for example, Denmark, the Netherlands, and Finland, but also in Slovenia and Germany, the UK, in British Columbia and Canada, and in Colombia. But things are moving rather slow, and it's understandable because there are many barriers to implementation. I'm sure you have some barriers in your head as well right now. For one, for example, there's data availability. Can governments put a price on something that's not measured? No, you need to have a measurement system and data availability to create these types of policies. Then there's the collection tax capacity issue that plays in almost everywhere. There's the short-term interest versus long-term interest, and governments generally having a short-term perspective, as their tenure is not longer than maybe a few years. So it's hard to make policies that build towards a better future if you only have a short time frame. And then there, of course, there's business and sector interests that diverge. And there's interesting developments there, which we will touch upon. We decided to try and contribute to this discussion. And over the years, we've done a number of publications to support that. First of all, in the Netherlands and the European Union, the 27 countries of the European Union, which is basically our backyard. Then we did a study for Finland on how to align their circular roadmap in a fiscal way. And then we did the report with the ACCA, and currently, as I said, we're working on a study on Bangladesh, which will be out later this year. Just to give you an idea of our findings for the European Union, this research we did with Deloitte, EY, KPMG, and PwC, who contributed pro bono to this research. We also worked with TrueCost and Cambridge Econometrics. We developed a policy toolkit, let's say a dashboard, to show which buttons governments can push to actually shift tax revenues. So on the left-hand side in blue, you will see some options for government for the use of revenues. And on the right-hand side, you will see more than 100 options for raising revenues. And there's tax bases ranging from air pollution, fossil fuels, metals and minerals, and water, also energy, waste, etc. So there's a lot of options here. One of the questions I often get is, what if a carbon tax is effective? Doesn't it erode tax revenue? In other words, is it a safe tax base for governments to go to? And my answer to that is, carbon is just one of the more than 100 options for governments to put a price on resource use. And it's probably one of the first things, or the low-hanging fruit in many countries to do, because of the sense of urgency, and sometimes also the data availability. But as most pricing schemes show, that you can plan for pricing to go up over the years if in order to make up for lost revenues, or of course governments can shift to different tax bases. And as the world is changing faster than ever before, it requires government to be agile and to be on top of the game and look at the main issues in society. I think the days are gone where governments can just set up a system and wait for 50 years to change it. We have to become more agile and more adaptive. We created from that toolkit, we created a scenario for the EU in order to illustrate what this might look like. It's not a road, it's not a blueprint or anything. It's meant to give this idea of what can happen if we were to shift significantly from taxing labor to natural resource use. And the scenario in the EU looked at 630 billion US dollars. So reducing labor taxes by that amount and raising the same amount by 2020. And the cost of labor would go down for both employers and employees. For employers, it would help them hire more people. There's a payroll tax credit in there, but also for consumers and the public, there's employee social contributions to compensate for increased costs of consumption. And there's a reduction, for example, of the employer social contribution, as well as a payroll tax credit for circular innovation. On the right-hand side, there's a price on fossil fuels. There's a price, the VAT rates go up, and there's a tax on carbon, as well as an increase in electricity tax and water tax for bulk users. Then the modeling results. The results show that over the years, employment and GDP are actually higher in the scenario compared to business as usual. So there is no harm to the economy. Au contraire, it's GDP is higher than in the business as usual scenario. Energy resource use and water use, as well as carbon emissions, are down significantly compared to baseline. And this means adding more than $1,000 billion in GDP over the years. It means saving more than $34 billion in energy imports. And it means by 2020 having 6.6 million people more in employment compared to business as usual. So this research illustrates that it's not a question of having to choose between development and environment. They go hand in hand. And saving costs. So we were very, very happy to see the support for this report of Angel Gurria, the Secretary General of the OECD, who wrote, based on our report, that we have enough evidence to support green tax reform and concrete policy action. But a frequently asked question we always get is, what are the impacts? How does this work in low and middle income countries with different challenges or different issues? And that is super relevant. So we looked at the SDGs and noticed that tax policy targets are mentioned in 4 of the SDGs. And the first one, on no poverty, says we need to ensure significant mobilization of resources from a variety of sources. In SDG 10, it says adopt policies, especially fiscal, wage and social protection policies. In 12, on responsible consumption and production, it says we need to restructure taxation and phase out harmful subsidies. And then in the partnerships for the goals, goal number 17, it says we need to strengthen domestic resource mobilization. So I think, in my honest opinion, tax could have played a lot bigger role in the SDGs, but I think this is already very, very significant and important. And we found that there's potentially a large social impact. The World Bank has found out that in 60 out of 87 countries, a $30 per ton CO2 domestic carbon tax would provide the resources to more than double current levels of social assistance in the countries. So we decided to do a first case study, and we were invited to do that with the CNA Foundation. As we're still working on this this study, this is all just a preview, and I really hope to be able to share the final findings with you very soon. Bangladesh is an amazing country, and I hope we have a few Bangladeshi present right now. It's a country that is very, very susceptible to climate disruption. And although it's only responsible for 0.1% of global carbon emissions, it's bearing the brunt of the impacts of the climate crisis. It's expected that by 2050, 30 million people could be displaced through climate disruption. At the same time, the country is showing extreme resilience towards these challenges, so that is very admirable. With regard to pollution, the country has severe challenges as well, with 100% of the population living in areas with pollution levels that exceed WHO benchmarks. There's 165 million people living in Bangladesh, which is a very large population. The country has a great track record of reducing poverty rates, providing electricity to its population, etc. So the country has a track record of dealing and creating effective policies. With regard to tax, the country has the third largest tax revenue gap in the world. So there's probably a need for more tax revenues. With regard to the labor market, there's 2 million people, young people, entering the labor market every year. So there's a massive need for good and decent jobs. Of course, the report will tell a lot more, give a lot more information on Bangladesh. It's too difficult to summarize a country within one short slide. But as you will appreciate, the country is in major challenges, but also has this track record of solving many issues. In our work, we have developed a methodology to take a look at different countries. So first of all, we identify national priority challenges because these differ from country to country. Then we go and look at data. How many data can we have? What do we have to work with? We build a scenario based on the possibilities and the data, as well as the priority challenges. And then we conduct a detailed exploration in order to understand the dynamics in the economy and the labor market and socially through analyses by Cambridge Econometrics, who have built a model to be able to do this type of analysis. So we expanded for this purpose the use of revenue side of our toolkit that I showed you previously, because of course in low and middle income countries, as I said, the challenges can be different, the needs and the desires as well as the goals can be different. So we try to capture them in the options for the use of revenues, and we will be developing this over the years. So if you have additional issues, I'd be more than happy to include them. We try to build scenarios based on the Bangladesh situation, and we figured that due to very limited data availability on resource use in some parts, we focused on a carbon tax for bulk emitters, which would raise $3 billion in 2025 in the scenario, and phasing out subsidies to natural gas and oil, which would raise $1.3 billion by 2025. So overall, that would raise $4.3 billion in revenues in 2025. And then we have two scenarios for the use of revenues. One is called the infrastructure scenario, in which the bulk of the revenues are invested in infrastructure. 3.6 billion is invested in infrastructure. And since Bangladesh is the second largest exporter of textiles after China, so the textile industry is the garment industry is very important. It provides 80% of the exports, and is very much depending on the fact that the subsidies for natural oil and gas, as well as for not paying on the carbon emissions. So if you phase in a price for that type of industry, the results are quite negative. So we decided to carve out part of the revenues to support that industry to invest in clean tech. So to make them more resilient and more future-proof, they could develop new technologies that use less water, that use less energy, that et cetera, et cetera. So in the infrastructure scenario, the bulk is used for infrastructure, and part of it is used for clean tech investment in the garment sector. Then the second scenario is what we call the social spending scenario. In this case, in this scenario, most of the revenues are used for social spending for the lowest two quintiles in the Bangladesh society. And then again, the clean tech investment is at the level in this scenario. The modeling results by Cambridge Econometrics show that in each of the scenarios, GDP levels are higher over the years compared to business as usual. So both scenarios are good for the economy. Both scenarios are also good for employment. Employment levels are higher in each of the scenarios. When we look at carbon emissions, they are each significant in each scenario, significantly lower than the baseline. So it helps reduce carbon emissions while growing the economy and employment levels. The main difference between the two scenarios is consumer expenditure. Consumer expenditure in the first scenario, the infrastructure scenario, is down compared to business as usual. It has to do with that the prices of things go up and consumers are not compensated. In the social scenario, of course, the lowest income groups are compensated, so they get to spend more and also thereby boost the local economy. So consumer expenditure in the social scenario is up compared to baseline. And of course, I often get the question on what does this mean for different low income groups. Both scenarios are progressive, but only in the social scenario, the poorest 2 quintiles actually gain in terms of real income significantly compared to third and fourth and the richest quintile. And this is in line with the findings of the World Bank saying that even though indirect taxes in general are regressive, they may not increase inequality if the proceeds largely benefit the bottom of the distribution. So careful design is very important. So the benefits for Bangladesh in the scenarios is pretty clear. There's a resource mobilization, there's higher GDP, job creation in each of the scenarios. There are significant carbon emission reductions, there's savings on energy imports, and there's public investments that differ, of course, in different scenarios. Another frequently asked question, of course, that we get is what are the impacts on businesses and sectors? Now, our research shows that most sectors, overall, the economy has a very positive impact of the scenarios, but there are exceptions. So especially the garment industry shows a small negative impact. But in the report, we also explain how they will operate in a better functioning economy, and the support in terms of clean tech investment is not yet included. But it's a challenge. It's a challenge. What we do see is that the role of business is changing significantly around the world. Businesses, as I said, are developing new business models, also in the garment industry. Many businesses are now supporting carbon pricing and are applying internal carbon pricing and water pricing. Basically from the understanding that there is no business as usual in a 1.5 degree world. Everybody will have to move. And the risks are rising. 250 of the biggest global companies have valued the climate risks to their business at $1 trillion. And these are interesting data because it means that the business community is aware of these risks and is stepping up to the plate to try and stop these risks. Interestingly, there's been a statement by 350 investors with $30 trillion in assets saying, please put a meaningful price on carbon. And these are interesting, very interesting developments. Carbon pricing already is on the rise. There are now 57 planned or implemented schemes around the world. Carbon is now a $82 billion market in 2018, which is an increase of 58% compared to 2017. So carbon pricing is on the rise. At the same time, I need to say that only 5% of carbon pricing mechanisms are priced according to the goals of the Paris Climate Agreement. So there's a lot of work to be done. The 1,400 companies already imply an internal carbon price. They say governments are moving too slow. We see the risk rising And we want to make better investment decisions. We want to make sure that the investment decisions that we take today are still valid in maybe 5 or 10 years. And this is why they start using an internal carbon price, let's say a fictitious carbon tax, in order to improve their long-term decision making. Now, the idea, of course, would be to, what if we could leapfrog into the SDG era? Leapfrogging is generally associated with bypassing stages of technology that other countries have gone through. And we see incredibly interesting examples. For example, with Bangladesh providing more than 4 million homes with solar, providing more than 4 million solar homes, actually reaching out to 18 million people, providing solar electricity just over a period of 2003, 2018. So these are massive developments. And Morocco, for example, is building the world's largest solar thermal power plant, again, skipping the fossil fuel development. This Chinese city of Shenzhen has electrified more than 16,000 diesel buses over a period of 5 years, which is an incredible achievement. But leapfrogging is generally associated with technological development, but we think you can also look at policy leapfrogging. What if we can leapfrog to align financial incentives with the goals that we have in terms of the SDGs, but also economic growth, of course, and job creation? What if we can have growth based on human potential instead of natural resources, and tap into that potential of our populations? In the words of UN Secretary General Antonio Guterres, tax pollution and not people. So thank you very much. Together, I think we can turn tax into a force for good. And I really look forward to our conversation today and hopefully in the future. Thank you very much.